My clients are always the parents of children with special needs, and they all know that they need wills with Henson Trusts to provide for the children when the parents are gone. But a lot of them say to me, well, I have a modest amount of money, I have a modest estate, and I don't know how much of that will be left when I'm gone. I have needs of my own when I'm old. So we always discuss the possibility of funding the trust with life insurance, because it's actually a very economical way to do this, and it provides a certain amount of peace of mind, because you know that if you die with nothing, you'll certainly die with life insurance. So for example, if you're a female non-smoker and you're 63, you could purchase a fixed premium for life insurance policy for about $200 a month. That's about $2,400 a year, to pay $100,000 on death. Now, if you take the annual premium and divide it into the payment on death, which is paid directly to the trust, there's no probate involved, you'll find that that would be a contribution each year of about 40 years. You'd have to save $2,400 a year for 40 years. Now, if you're a 63-year-old female non-smoker, I think the likelihood of that is small. You may well live to be 102. I don't think you're going to live to be 103, frankly. So you could consider that. And if you happen to be a much younger couple, for example, suppose that you're a husband, 32, wife 29, you have 3 young children, and the middle child, who's 7, has autism. Well, I think that it's a fair shake that, for example, mother may be at home with the children, dad's working overtime, you're not saving a lot of money, but you could buy life insurance on the parents' lives, and to insure the wife, the mother, non-smoker, age 29, the premium would be about $50 a month, and on the husband, who's 32, a smoker, would be $85. And if you had a joint and last policy with a fixed premium that pays on the second death, that too would be about $50 a month. And if you wanted a joint and first policy to pay upon the first death, whichever one that might be, that would be about $100 a month. So you can see that if you were the mother, age 29, and you were paying $50 a month, that's $600 a year, you'd have to accumulate $600 a year for 166 years, which obviously is not going to happen. Now, one of the reasons that this works is that all of the other people who buy life insurance, yourself included, have term policies. And they may be term 20, but at a certain point when you either stop working at a certain employer's workplace, or you decide that you've paid all these years, you don't need to pay anymore, and you quit, well, obviously all those premiums are wasted because, fortunately enough, you didn't die. So this is what's called the lapse factor. And the insurance companies, of course, make money when they collect premiums and you don't die, or you stop paying. In fact, only about 5% of term policies ever actually pay out, which is, surprising, shocking, perhaps. But that's one of the reasons that they can afford to have much more affordable premiums on all of these fixed term policies. So my suggestion is that you consider this, and these trust funding arrangements with insurance would immediately fund the trust, for example, within 30 days of death typically, so that if your child's needs are more immediate because you're helping to provide for them on an ongoing basis each week or each month, there would be funds available quickly. You don't have to wait for the probate process to take its course.